Today we're covering corporate formation and finance. A corporation is a legal entity created under state law that exists separately from its owners, known as shareholders. Because it is considered a separate legal person, a corporation can own property, enter contracts, sue, and be sued. It also has perpetual existence, meaning it can continue operating even if ownership changes. The corporation is managed through a three-level structure. Shareholders own the corporation, a board of directors makes major policy decisions, and officers manage day-to-day operations. One of the biggest advantages of the corporation form is limited liability. Shareholders generally are not personally responsible for corporate debts beyond the amount they invested in the company. Corporations are subject to taxation on their profits. Those profits may either be distributed to shareholders as dividends or retained by the company as retained earnings for future growth. One major disadvantage is double taxation. The corporation pays taxes on its profits, and shareholders may also pay taxes on dividends they receive. Corporations can be classified based on location. A domestic corporation is incorporated in the state where it conducts business. A foreign corporation is incorporated in one state but does business in another. An alien corporation is formed in another country and conducts business in the US. The corporations can also be classified based on purpose. A public corporation is owned by a government entity, while a publicly held corporation is owned by private investors and has shares traded on public stock exchanges. Private corporations operate for profit, while non-profit corporations are organized for charitable, educational, religious, or other non-profit purposes. Another important classification is the difference between S corporations and C corporations. A C corporation is subject to double taxation and can have unlimited shareholders. An S corporation allows income to pass directly to shareholders, avoiding double taxation, but it is limited to 100 shareholders and must meet certain IRS requirements. Creating a corporation involves several steps. First, the incorporators choose a state of incorporation. Next, they select an available corporate name. Then, they prepare the articles of incorporation, which include information such as the corporation's name, the registered agent, and authorized shares. After filing the articles with the state and paying the required fees, the corporation officially comes into existence. The corporation then holds its first organizational meeting and adopts bylaws, which establish internal management rules. Corporations possess both express and implied powers. Express powers are specifically granted by state law, the Articles of Incorporation, and the corporation's bylaws. Implied powers are those reasonably necessary to carry out the corporation's business activities, such as borrowing money or entering contracts. Although shareholders usually enjoy limited liability, courts may sometimes pierce the corporate veil and hold shareholders personally liable for corporate debts. This can happen when owners commit fraud, fail to follow corporate formalities, undercapitalize the corporation, evade legal obligations, or mix personal and corporate funds. Courts may also apply the alter ego theory when the corporation is essentially being treated as the owner's personal business. Corporations raise capital through several financing methods. They may issue stock, issue bonds, obtain venture capital investments, receive private equity financing, or raise money through crowdfunding. There are two major types of stock. Common stock provides ownership rights, voting rights, and the potential for higher returns, but dividends are not guaranteed. Preferred stock generally provides fixed dividends and priority during liquidation, although it often carries limited voting rights. Stocks and bonds differ significantly. Stocks represent ownership in a corporation, while bonds represent debt. Stockholders are owners, whereas bondholders are creditors. Bondholders receive fixed interest payments and are repaid before shareholders if the corporation dissolves. Stockholders, on the other hand, benefit from increases in the company's value but take on greater risk. Understanding how corporations are formed, managed, taxed, and financed is essential because corporations remain one of the most common and influential forms of business organization in the modern economy. Thanks for watching.